Hi, welcome back to week 5 of the Basics of Creating Wealth. I am your hostess with the mostest, Mr. Craig Saloner, coming to you from the Station Collab in Carlsbad, California, where producing the greatest content to evolve human performance. Really stoked to be here. I feel like we're really getting into the meat, the crux of things. We've gone through a lot already, and I'm just going to go over sort of doing a broad overview of what we did. Last week was a really big, powerful topic. It was around compounding interest and around passive income. So we're learning that there's a system, there's a method to the madness, as I keep saying. There really is a method to the madness. In week 1, we spoke about our relationship with money and really getting good with how we buy and how we take and how we charge and how we interact with money and really looking at our belief systems. And we've been going into the soul of money with that beautiful Lynn twist and all the magic about moving out of the scarcity paradigm where there's not enough and more is better and there's nothing we can do about it, and really moving into the sufficiency paradigm where if we really take a look at what do we need, we know we're so nurtured and taken care of, and that part of the brain that says that there's not enough, that almost mammalian part of our brain from prehistoric times that fought for survival, we can let that rest and really just allow that to settle so that we can feel abundance. And in that feeling of abundance, we can begin to attract abundance. And it's a system that really works really beautifully. And with that, we developed a money management system that I shared with you, where we split our money into these 6 accounts, each of them representing a different part of the financial muscle group. We had our basics, and then we had play, and we had give and health and wellness and savings, and of course my all-time favorite, the Financial Freedom Fund, which is what we're going to talk about now, right? And we can understand, and I was very adamant, and when in that week I was like, listen, if the only thing you do and the only thing you get out of this is to open that account, while I'm not stoked because you need to exercise the other muscles, the key to long-term sustainable wealth is through becoming an investor, moving out of being a consumer and moving into becoming an investor. And we do that through this Financial Freedom Fund, right? So that's our very first account there. We've got to open. We've got to start paying ourselves first. We've got to start getting our money working hard for us. And I call them our little soldiers. And we get these little soldiers that are out there making money for us. So that's the big paradigm shift that we're going to go through, from us working hard for our money to our money working hard for us. And what do? We take that money from the Financial Freedom Fund and we invest them in investments that create streams of passive income. All right, and we went over a lot of that last week. Stocks and bonds and the stock market and property, and creating businesses and systemizing businesses so that you can begin turning that into streams of passive income. All right, but we remember that just creating streams of passive income is not enough. There's a very secret ingredient, and this is what Einstein said was the greatest human invention. The 8th wonder of the world is what he called it, and that is compounding interest. So when we get money, it gets pulled off of investment. It's got to get reinvested, people. Please, it's got to get reinvested. That's the secret. And we said last week there was 3 things. Who can tell me what the 3 things were, right? We needed for the reinvestment of the earnings. That was our first facet of compounding interest. Our second was that it needed a good interest rate. So the higher the interest rate, the quicker you double your money. The law of 72. Divide 72 by the interest rate and you'll know how often you're doubling your money. Yeah, and it needed time. So the earlier you can begin investing, the earlier you can teach your kids, the earlier you can share this information, the quicker you can begin doing this, the more times it gets to double on itself. And as it doubles and doubles and doubles, it just grows to astronomical proportions, as Mr. Warren Buffett will tell you, the greatest investor of all time. Okay? So this is the system that we're learning, right? Now, what we're going to talk about today are things that can erode that system. All right? And there's really 3 things that we're going to discuss today. First one's credit card debt. The second one is taxes. And the third one is fees. All right? Because here's the important part. Okay? It's not what you make that matters. It's what you keep, okay? It's not what you make, it's what you keep, right? Because if you make $100,000 and you tax at 40%, then it doesn't matter that you're making $100,000. What you've only got to earn and to grow and to compound is $60,000. And then you've got to pay all your bills and all your things and da-da-da-da-da. And by the time you left, either you don't pay yourself at all, or you pay yourself a minimal amount, and it takes you much longer to reach our fantastic equation, which is financial freedom is when your passive income is greater than your living expenses. So my goal in sharing this with you, and my goal in my own personal life, is to achieve financial freedom, where I have enough of this, where eventually you get enough passive income through a compounding basis that the revenue, the payoff that you get is greater than your living expenses. And again, it takes time and it takes effort and it takes discipline. Nothing here is get rich. Nothing here is just let it go quickly, okay? Let's jump into it. So the first thing I'm going to discuss, and we've spoken about it throughout the course, is credit cards. All right? Credit card debt, like I said, credit cards, as I've said multiple times, is like a sharp tool. It's wonderful when used properly, but if used incorrectly, it will cut you and it'll bleed, right? And you can understand it. So when you're paying 19 or 24% on your credit card, it's not just that you're paying 19 or 24% on your credit card. It's not the $100 or $150 in interest. When you compound that $100 and $150 over a long period of time, that becomes astronomical. Okay, and just by removing $100 or $150 every month from your financial freedom fund, then what really it does is it begins to erode. And we're going to be talking about erosion throughout the day. I'm going to use that word multiple times because that's what happens. It slashes at the financial freedom, and it slashes at, just as we compound exponentially, right? When you add to it, it compounds exponentially. So too, when you take away, the effect is exponential. And that's what I'm trying to get you to understand. When you go buy those expensive pair of shoes, or you go buy those new golf clubs, or you go spend all that money on a new watch or on a vacation that could have gone into the financial freedom fund, there's a cost of that money, and it's not just the cost. It's not just the principal. It's the exponential, it's the compounded version of it. Okay? And this is what I'm trying to help you to understand. The more money you can put into that financial freedom fund, the more little soldiers you can get working and duplicating and growing exponentially, the quicker you get to your financial freedom. So we've spoken about this and how to get those credit cards down to zero. Firstly, go and renegotiate. Go call your credit card companies. Get that thing down to zero. Tell them you're going to move your business if they don't renegotiate. Or move your business, or get a zero balance transfer. Get that thing under control, right? Then you take money out of your long-term savings and you pay that down. And you take money out of your play jar. And you build that thing down to zero. So the first thing we always do is we always renegotiate with the credit card companies, and then we work diligently to pay that thing down, right? But not at the expense of the financial freedom fund, because that's your golden ticket, right? That's the golden goose that you're building that's going to produce you the golden eggs. I think everybody understands that. All right. So that's the first thing is credit card. The next thing we're going to work on is taxes, okay? Taxes, the wealthy understand how to navigate taxes, okay? Because there's no single bigger factor that will erode your financial health than taxes, okay? It's just built for people that don't understand it. And so a lot of what we got to do is really begin to understand it, and that's part of what we're doing, okay? Couple of ways we can navigate with taxes, all right? And that is to invest in, there are vehicles that you can invest in when you take your money. There are vehicles that you can invest in that grow in tax efficient structures. And that's what we're always looking for. We're looking for tax efficiency. We're looking never for tax evasion, avoidance, and efficiency is what we're after. Okay, so there are two main vehicles in the investment world that a lot of people know and understand and are familiar with, and I'm just going to go through them now and just give you a quick overview of the differential between them. The first is your 401k, right? Your 401k. So money comes out of your financial freedom fund, and it can go straight into a 401k, because what's a 401k doing? The 401k is investing it in the stock market. It's investing it in investments that earn passive income, and it's compounded. So it's a fantastic vehicle for growing our long-term wealth. That's why it was done. It was done almost as a mechanism for forced savings and forced retirement, because people knew, the government knew, that if they didn't have some vehicle, people wouldn't save and they would get older and they would retire and they wouldn't have enough money. So the 401k system was done. Now, I want to just give you the difference between the 401k and the Roth IRA. Okay, and just give you a quick overview of what the differential is. The 401k, let's say you choose to invest $10,000. Pay taxes on the 90k. Okay, so that's taxes. You pay taxes on the 90,000, and as it grows, so you see that you took 100,000, but you paid 10,000 into your financial freedom fund, into your 401k, let's call it, and you land up only paying taxes on the 90,000. Now, what happens is that this thing, when it grows, and it's going to grow compounded, and let's say in 30 years it's worth 200,000, let's say, 200K is when you sell it, you are going to be taxed on the 110,000. Okay, so you're going to get taxed. So what it does here is it avoids you instead of paying tax on the full 100, you only pay tax on the 90. So you get to actually have a tax benefit very early on, but you land up paying it at the end. Okay, that's in contrast to the Roth IRA. Same $100,000 that you make, and same $10,000 that you put into your Roth IRA, which then gets invested into the stock market or into different bonds and stocks and bonds, and it grows to compounded. Now, with the Roth IRA, you pay tax on the full 100K. Okay, so you do not get this tax benefit now. However, the beauty of the Roth IRA is that when this thing grows to 200,000, you pay zero tax. It grows in a tax-free structure. And that's why I really like the Roth IRA. Okay? So you're paying zero tax on all the growth from 100 to 200, you pay zero tax. That's your primary difference between your Roth and your 401k. So everyone asks me, well, what should I do? Should I do a Roth? Should I do a 401k? I do not give investment advice. I can only tell you this. I believe that I do not know what tax structures are going to look like in the next 10 or 20 years or 30 years. My feeling is that taxes are only going to go up as the economy, as the national debt carries on, as Social Security starts to falter and fall and that's why I prefer the Roth IRA if you can. There are limitations, there are funding there are maximums and minimums on how much you can invest. But again, these are two major tax structures that you could use for your financial freedom fund, that your money grows in tax efficient structures. Okay, and so these are very good. These are very good vehicles, and what you should do is talk to your fiduciary or your financial planner, your financial consultant, to discuss these. All right. So one vehicle, again, to reduce our taxes is the 401k and the Roth IRA, creating tax-efficient structures to invest our money. Now, there are other ways of not paying so many taxes. One, I'm a big fan of if you're an entrepreneur, to have your own business. Even if you're working for somebody, to have your own business and to be able to write off as many expenses as you can, as many deductions as you're able to against the income that you earn. Right? So the way we pay taxes is you earn income and then you take off all your deductions, and then you have sort of a taxable income, and you get paid on that. So the more deductions that we can bring into our expenditures, the better. For example, if I talk on the phone about business, then my phone and my cell phone bill is a deduction. I can bring that in against my income. So too is my car. And if I've got a home office potentially, and I use that for my business. If I do travel, if I go to take business clients out for dinner, if I give charitable donations, all of those things are now tax deductible. They come off of the bottom line and you pay less tax. So I'm not a tax expert. However, I do know the value of tax planning and of being very diligent, because I understand the system. Can you understand? Can you get it? If you're overpaying taxes, it gives you less money to invest. It erodes your ability to grow the thing compounded, and it has a huge dent in how you're able to attain your financial health and wealth. Okay, so we're going to be very careful, start paying attention. Now, what I really recommend is getting a bookkeeper and getting good sets of financials, getting organized, knowing what's going on in your financial life. I know we've got a lot of ostriches in the house. I know we've got a lot of people who are like, I can't afford a bookkeeper. Let me explain something. You cannot afford not to have a bookkeeper. If you're in business, a good bookkeeper will save you thousands. Will save you thousands in taxes. You'll begin to see there'll be transparency in what you're doing, in what your business is happening. You'll begin to understand your financial statements are a blueprint. They're a record of what's happening in your business world. So if you're an entrepreneur, if you're a self-starter, if you're a solopreneur, if you're a 1099 consultant, you need to keep set of books. You need to run expenses against your income so that you can minimize the amount of taxes that you pay, right? The other thing that I'm really a big fan on is to pay quarterly taxes. For those of us entrepreneurs that are 1099, pay quarterly taxes. You remember we say we're going to hold them in the long-term savings, get them out of there, pay them, and keep going. What I don't love is the end of the year surprise where we underestimated our expenses, we underestimated income. All of a sudden we got a huge tax bill we got to take care of. Okay, so we're going to keep our eye on. I know it's another whole thing, but you're getting into the game, and part of the game is taxes, and we're going to deal with those as well. All right. The next thing that really smacks you, and these are the hidden things, are fees. Okay. Now, if you read Tony Robbins' book, I have never seen a man be so vigilant against fees, and he really nailed it into me and nailed it in all his books about how dangerous these fees are, okay? And most people don't even realize there was a statistic that 92% of people in their 401ks had no idea of how much fees they paid. 70% of people thought they paid no fees at all, and it's just not true, right? Now, just like as in taxes, when you calculate the impact of excessive costs, of excessive fees, multiplied over many years, it actually takes your breath away. A lot of the mutual funds, we spoke about this last week, a lot of these actively traded mutual funds, the reason they're so wealthy is because they charge you literally on every transaction sometimes, but certainly monthly and annually. They've got all these hidden fees and you don't see them, okay? Now I'll give you, that's why last week, if you remember, I was a big fan of the Vanguard 500 or the Vanguard REITs. Why? Because they don't charge fees. Their fees are minimal. They're like half of 1%. That's in relationship to other mutual funds or actively traded funds of 2 or 3%. Now, I know you may not think it's a lot, right? But if you have two people and they're 35 years old and they invest $100K, they invest $100,000 over 30 years at 8%, all right? And one has a 0.05% and one has a 0.02 in terms of the fees, all right? Then by the end of the 30 years, the person who's paying that is get $865,000, right? Because it's compounded and right? And the other one has $540,000 in fees. So you can just see like that 1.5% in fees has eroded your wealth by over $300,000. So we got to pay attention, all right? We got to pay attention to the little things. One of the big things that I'm a fan of is to find a good financial planner if you can, a fiduciary, one who's not working for one of the bigger brokers, but that is independent, all right? And that can help you and guide you. But pay attention to the fees. That's the first question you should be asking. And sometimes you don't need it because, again, if you've got a 401k or a Roth IRA, fantastic. Make sure you know within this Roth IRA where they're investing and what are the fees. Okay? Make sure you're doing proper tax planning. All right? And when you're investing, and as you're going to do this, and as you're going to get into this game, remember the three in real estate. It's location, location, location. In investments and in money talk, it's diversification, diversification, diversification. You need to be diverse, Okay, that's why I don't like single stocks. I don't like I don't like to invest in single family houses. I like to invest in, number one, different asset classes. So I like to have a little bit in my stocks, and I like to have some in bonds, and I like to have some in gold, and I like to have some in property. I'm diverse over different asset classes. And even within the asset class, even within property, I don't just have one. I don't have all my eggs in one basket. That's why I like the REITs, right? You can invest, it's simply, that's why I don't like one stock. That's why I like index funds. 500 of the stocks. So if one goes up, one goes down, it's going to balance. Over the long term, you're going to have slow and steady growth. You're going to have that magic number, 10% compounded annually every 7.2 years. Your money's doubling, double down. Okay, and that's how you begin to build long-term wealth. That's why you see these big families, these old long-term families. Every 7 years, they're doubling their millions, their billions, right? Warren Buffett, and I shared this last, he didn't want to give away his charity because he realized that he could compound it faster than any charity. And so that's just a lesson from the greatest mind in financial history probably, who just understood this concept. And I'm trying to teach that to you guys as well. So we want to be diversified across different asset classes. Even within the asset classes, you want to be diversified across different markets, countries, currencies. I play in different currencies as well. And also you want to be diversified across time. And that's why this system, diversified across time, means that you're constantly, you're not just putting all your money in on day one. Okay, because if you put all your money on day one and that happens to be at the peak of the market and then the market crashes, it's going to take you a very, very long time to ever get that money back. However, if you invest over a period of time consistently, which is the system that we've created with our Financial Freedom Fund, every month we got 10%, minimum of 10% going into that, and we're making investments constantly, we're basically diversifying our investments over time as well. And this is how you grow to be long term. The other thing that we don't want to do is we don't want to be emotional in our investing. And that's a huge issue with what happens. The market goes up, we buy. The market goes down, we sell. But if you don't even worry about it, so much mental, emotional energy. The interesting statistic is that while the S&P 500, the stock market, over the last 100 years has made close on 10%, 9.8%, the average person has made 3.3%. Why? Because when things are good, they buy, and then they land up being high. And when things go bad, they sell. And so they don't stay in it for the long run. There's too much emotion that happens. And what I'm trying to do is get you emotionless. If stocks and bonds are not your game, then don't worry about it every day. Simply invest, set it and forget it. That's the mantra here. Set it and forget it. Make it automatic and let it just grow and let it go. Because what you're doing is you'll run the bull markets, you'll run the bear markets, and basically you'll land up, over time, you'll start to see your portfolio go up on a standard, on a sweet and steady rate. So the last few minutes of of today's lecture, I just want to talk to you about a few things. And remember when we spoke about at the beginning, it's all about settling the nervous system. It's all about feeling like you've got control of the situation. You've got your head out of the ground, and your head out of your ass, and you're actually making real solid movements in terms of the different directions you're taking, okay? One of those that really calms my nervous system is insurance, okay, and life insurance in particular. And I'm just a big fan of insurance in general. I know the insurance companies make a lot of money, and that's okay because it gives me a peace of mind, right? So certainly with as a family man, as a father of 3 and a wife, it's very important that I know that if anything had to happen to me, that my family is taken care of. Okay, so there's 2 primary types of insurance that I want to just quickly go over. The first one is term insurance. That is it's fixed for a period of time. You pay the same rate every month, and if you die within that period, it pays out. So it's a very simple, it's very cheap. It's the cheapest type of insurance. I think I pay like $80 a month for $1 million worth of coverage. So for me, I can go to bed every night knowing that if I don't wake up, my wife's got $1 million. Maybe I should sleep a little harder because but anyway, it's good. It's good to know that like you're taking care of your loved ones. The other type of insurance is whole life, which provides death benefits for your whole life. It's not limited to a term. So terms usually 15 years, 20 years, 30 years, where whole life, as long as you pay your premium, it goes for the whole period. There's other benefits to whole life insurance that accumulates cash value that you can that grows. So it almost starts tapping into your financial freedom fund, and it grows over your time. So again, there's many insurance agents, there's many types of insurance that the scope, it's beyond the scope of what we're doing here today, but it's good for the family and it's good for the soul. The other thing that I'm really adamant on is that everybody gets a will and has a last will and testament. This is so that if anything happens, your assets, all the assets and the liability, all the assets that we've been building, everything that you're going to be growing, that you know when you die, it's going to go into the right hands, and that it's not going to go into the courts, because that's what happens if you don't have a will. Even though you may have a wife, you may have kids, who knows, it'll go into probate and it'll be run through the courts, and money may land up not where you're wanting it to. Okay, so actually, as part of my gift, I've got a generic will template I'm going to be sending to everybody, and that's going to be part of your homework this week, is to fill out the will and make sure you speak. And that includes if you have children. When God forbid you die, where do your kids go? Can you imagine? And where do your kids go? Where does your money go? Who do you want to be the beneficiary of your insurance policies? All of those things will be filled out in that will. Okay. I also want you to just finish the Lynn Twist book. It's such a beautiful book. Let's finish that out. And then just go over and start looking at what's some of the fees and the taxes. If you have insurance policies, I want you to go into those insurance policies. If you have a broker, I want you to call them and figure out what kind of fees and what kind of taxes are you paying. And then start looking into life insurance, and really, even if you're single, even if you don't, the younger you are, the cheaper it is, the healthier you are. Insurance works again on age, so the earlier you can get it in, the earlier you can just settle your nervous system and feel abundant and get that financial freedom fund going. You're on your way to full financial health. Thank you, and God bless.